Since the days of bartering your goat for a new bed frame, we have come up with a clever way of getting the stuff that we wanted in an organized way: money. Banks and their security and their relative convenience paved the way forward for many great human achievements. They literally finance most of our modern world. And yet, since the birth of the internet, dinky little startups have risen to the challenge of disrupting this. I'm talking about Stripe, Venmo, Tangerine, Wise, and the OG PayPal. But do they actually do what they promise to do? If you are not familiar with any of the names that I have just mentioned, these are just a handful of the many companies that have come to be known as fintech, which is just short for financial technology. Fintech is described as new tech that seeks to improve and automate financial services. The problem is that the banks and the world of finance is very complicated, hugely influential, and fundamentally averse to change of any kind. Now we're going to do some oversimplifications of the banking world, and that is for your benefit and your entertainment here in this video, but don't be mad if we get some of it wrong, okay? We're just making an analogy. The big banking world is kind of like your dad who still signs his name at the end of every text message. Our very modern move fast and break things world is not built for the don't be hasty mentality that worked for banks for a very, very long time. Here's the simplest banking example we could come up with. While most domestic transactions like buying your coffee and getting your salary are pretty straightforward and well managed nowadays, pretty much all international transactions are made through something called the SWIFT network, a system that was designed in the 70s, decades before the World Wide Web was a household entity. To this day, SWIFT is dependent on a manual input, meaning that if you place a transaction right before a holiday or a busy time of the year, you could possibly have to wait days for it to go through because a literal human has to punch the numbers in on a typewriter. It's not literally a typewriter, but you get the point I'm saying. Back in the 70s, this probably felt like a legitimately swift system. But in an era of instantaneous everything, a few days for a transaction is like a light year. On top of that, these transactions often involve various intermediaries who can charge for their services without you even knowing what they're doing or how it's happening. I talked to a contact I have at my own credit union about this, and apparently the banks and credit unions themselves often aren't always sure where these charges come from. My bank might send to their intermediary, say Wells Fargo, which then sends the money to the receiving bank's intermediary before it actually gets to the recipient. All, of course, along the way deducing fees that you have no idea even existed. In the end, you have a horribly outdated, inefficient, and costly system with major transparency issues. And that is pretty much how every international transaction gets around the world. Now, if you're a smarty pants with even half of a degree, you're sitting in your chair thinking, well, heck, boss, let's just toss some WD-40 on that sucker and get things moving, am I right? Maybe you're not a mechanic, maybe that reference makes no sense. But the problem is, you can't just simplify or update the system. The whole idea behind SWIFT is that banks from all across the globe, rich or poor, use it. It's safe, it's secure, and it's robust. But that last part requires widespread adoption. You can't just update some things on the bank without updating all of them. And if you've ever been on a family vacation or a bachelor or bachelorette party, you know that getting a bunch of people to do one thing at the same time is nearly impossible. And here is where fintech comes in. Unlike the lumbering giants who've drank way too many mimosas, fintech startups are nimble, quick on their feet, and swift to adapt. Their whole raison d'etre is to disrupt the current system with innovative solutions to common problems. PayPal was just one early success in a long line of entrepreneurs who have striven to do just that. The PayPal app was released in 1999 and allowed people to beam money between handheld devices. Not between smartphones, of course, but between pagers and Palm Pilots, which is very retro, and I love it. The beauty of this app was that it allowed regular people to send each other money digitally. Before then, banking infrastructure was there largely to facilitate in-person transactions. transactions. But PayPal represented a big step in democratizing the financial system, allowing people more control over how they use their money and making online marketplaces that much easier to use. It quickly expanded beyond just Palm Pilots and pagers and became a huge hit with the eBay crowd, who could then use PayPal to order Smurf TV trays and Alf alarm clocks with more convenience than ever before, which is great for the economy. Around the same time, good old Elon Musk also launched his own online bank, X.com, which is a weird and terrible name, which offered competing services until the two companies merged and then got bought out by eBay itself for $1.5 billion in 2002. That is an insane amount of money for such a young business. But the banking world was ripe for disruption, and entrepreneurs recognized that if you could offer something better than the status quo, there was a boatload of money to be made. Which is fine, companies can get money, and who wouldn't appreciate a quicker, cheaper, easier solution to our banking needs? But unfortunately, these startups are often plagued with much of the same issues as the big banks, largely because they still, for the most part, totally depend on the banks that they're seeking to disrupt. The thing is, banks have been a long-standing cornerstone of society for a reason. Here and now, banks remain the most widely trusted way to store our money while still retaining an element of convenience. And despite all of Swift's problems, it is the most robust and widely accepted method of moving your money across international borders. For all the bells and whistles of PayPal and Google Pay and all these bank-defying innovations, they only function within the banking ecosystem. In theory, you could use all of your money and transact your entire life only through PayPal without touching a bank, but in practice, that's not really feasible. Because for all of PayPal's growth, it is not a monopoly that everyone has bought into. And don't even think about transferring between fintechs, because that is not a fun experience, and I have the scars to prove it. See, the banking ecosystem is kind of how all of our financial structures are supported. And so even if you have a great financial idea, it has to exist within that financial world. And then you have to deal with all of that financial banking red tape that goes along with it. As my local bank insider put it, no fintech company that I'm aware of has yet to crack the solution to easily getting money in and out of the banking ecosystem. All of them struggle with this. This probably does not come as a huge surprise to any of you, but financial services are amongst the most heavily regulated sectors in the world. And for good reason. Every company is going to have its own laws about financial institutions and what they can and cannot do in order to prevent things like fraud, money laundering, theft, tax evasion, terrorism, all of those things. It's super complicated, it's freaking annoying, but it is one of the reasons why we're able to put so much trust in these institutions and how a lot of our global systems are able to continue working today. So these regulations are cumbersome and they're annoying, and they're complexities that have plagued the regular banking world and now the fintech world as we try to get to something better. Now, perhaps the option you're saying is to have a completely unregulated system of finance, which is where cryptocurrency comes in, but that would have to be an entirely other video.
Cryptocurrency, it's up and then it's down.
So for all of fintech's promises of a glorious low-fee future with quick transactions, they just can't deliver. PayPal might be faster and more convenient to send money abroad, but it will not be cheaper. PayPal and most of these fintech companies brag about eliminating fees and saving you money in a variety of ways with their convenient all-in-your-phone system. But this usually just means that they're making money at a different step of the process than you're used to. It's harder to see this as a customer, but just like with Visa or MasterCard, every time you try to use PayPal to say, support a local artist on Etsy, PayPal deducts a portion of your purchase for themselves, typically 2.9% plus a flat fee here in Canada, which means that sellers then have to up their prices in order to make a profit. Now, this is where I'm going to get a little more real with you than we do in normal future-proof videos. See, I've been a victim of these fees myself. I recently received a payment for $6,000 from a client through PayPal, and the fee that was deducted without any way for me to know what I was going to be charged beforehand was $222.30. I asked my bank what that would have cost if I were to do it through the Swift system, and maybe I would have had to wait 3 business days for it to go through, but it would have been $20 even. Fintech might be exciting and maybe even convenient, but it is not free. And that money is just going to another publicly owned, profit-driven company that does not embody your values most likely, which sounds not at all unlike the banking world. So here is the truth. Whether it is the oldest Swiss bank account hidden in a mountainside somewhere in the Alps or an app that you just downloaded on your phone that's named after a citrus fruit, banks are devoted to one thing and one thing only: profits. One of the banking world's favorite ways to make money is by taking your money and then relending it to someone else for a much higher interest rate. It is not uncommon for a bank to pay you less than 8% of interest while your money is in their institution. And they will then take that money and lend it to someone else on a credit card per se for 18%. And then on top of this, they have the audacity to actually charge you money to put that money in the account in the first place. Put your hand up if you've ever had money randomly disappear from your account for a fee that you didn't even know existed until the money magically vanished from your account. You can put your hand down. The extra painful thing here is that what they do with this money lending supports endeavors that are controversial, to say the least. Things like guns, fossil fuels, private prisons, and who knows what else that is in that fine print that you probably didn't even get to read. And this angle is something that the fintech world is trying to capitalize on as well. Nowadays, there's a bank for every possible person. The nomads have Wise, the environmentalists have Aspiration, the entrepreneurs have Square, and the list goes on. No, literally, the list goes on for a very long time. And for all of fintech's diversity and all their faults and striking similarities to the established system, they do serve an important function in the modern economy, if just to kick the butts of the banks into gear. This kind of competition is extremely important for driving innovation and making these services better for everybody who uses them. But at this point, I don't think there is a person who can predict what the financial system of tomorrow is going to look like. Already we are seeing governments address the rise of fintech and in some cases actually promoting its use. The UK, for example, has been pushing for more integration between traditional banks and third-party providers such as tech startups. We may eventually see more decentralized financial systems with big banks, small banks, and tech companies all working together to provide the best services that they can. So there's a lot of companies out there that are promising to plant trees if you bank with them, promising to give you a fee-free banking experience if you just switch over. However, every single banking institution in some way relies on profit, except in one specific circumstance: credit unions. Now, I have to disclose that on my other channel, I am sponsored by a local credit union and I promote their services. So obviously, I am biased in that way. But they are not sponsoring this video and I'm not even going to mention their name. But across the board, credit unions are more localized, have much lower fees, and often have much more progressive policies when it comes to social and environmental issues. Why? Because they are a non-profit entity. Credit unions are cooperatives, meaning that they are literally owned by the people who choose to bank there. When I signed up at my credit union, I had to pay a membership fee, which will be returned to me if I ever decide to leave the credit union. And because of this model, they can offer services that are very specific to their communities and their needs without fear of making a profit for their shareholders. The credit union model feels a bit more old school, in a barn-raising, community gathering kind of way. An organization built upon the agreement that we're all going to put our money in this one place to keep it safe, and the main reason is that we all just live here. And there's something beautiful about that. So I highly encourage you to not fall for the marketing genius of these massive banks or new tech companies and prioritize something that is local to your area, because you'll probably have a much better experience overall. So thanks for watching this video, and if you are subscribed to this channel, then we will see you in the next one.